Thank you, everyone, for joining us. And as we are a couple minutes past the hour here, we'll kick things off. Make sure and invite your friends. Tell them that you're listening in and that you're listening to this incredible conversation that we're going to get into. We hold our Twitter Spaces every Tuesday with alternating topics. This week is cash management with whole life insurance with our Infineo experts. A lot of people know this topic is infinite banking and using your cash flows to capitalize a whole life insurance policy and have that work for you and becoming your own bank. And that is what we practice and preach at Infineo. And so we like to hold these conversations where we discuss what we're doing in our personal lives with clients and just infinite banking as a whole. And so we've got 3 of our senior agents at Infineo here with us, Wayne Durksen, Liz Lamond, and George Roth, to share their expertise. And we're actually going to be doing this a little bit different this time. We typically hold these as kind of just an open forum, Q&A style, and we discuss various topics within infinite banking and cash management with whole life. But we really do have some very experienced industry veterans on our team here. And so we thought it might be exciting and valuable to actually interview one of our senior agents. So we're going to be interviewing Wayne Durksen, who has been practicing infinite banking for decades and actually is one of our senior agents, as I'd mentioned. And so with that, I'd love to have our panelists and our interviewee, Wayne Durksen, introduce themselves. So with that, Liz, would you like to introduce yourself?
Yeah, sure. Thank you. So, really excited to do this. Wayne is a, whole lot of wisdom and really some great nuggets that always come out when Wayne answers questions for us. So, I'm Liz Lamond. I work with Infineo. I have been practicing infinite banking, cash management with whole life insurance myself for a very long time now, as well as obviously teaching that to people that I work with. So George, who is also going to ask some questions with me, I'll let you introduce yourself first before we kind of jump in.
Thanks, Liz. Appreciate that. Yeah, so I guess I could be considered one of the old guys around here. So I've been practicing and teaching the concept for 14 years now, which kind of scares me to say that out loud. And I had the privilege and honor of learning directly from Mr. Nelson Nash himself. So honored to be here. Thank you. And look forward to hearing some good nuggets from Wayne. Go ahead, Wayne.
Well, thanks, Liz and George. And it is a pleasure and a privilege to be part of this team. And I feel humbled to serve alongside these folks and others. And so I've been in this industry a long time. I've had to do a lot of learning, and I did a fair bit of unlearning, but just so ever grateful that Nelson Nash was gracious and kind enough to take me on and help me unlearn and then relearn. And so I am a diehard advocate for helping people rethink their understanding of economics, finance, cash flow management, and so on. It's just a delight.
Thank you guys so much for those introductions and for setting the stage for us there, Wayne. Super excited to dive into this with you here. And so I guess just to kick things off, it would be great to hear about where you first heard about infinite banking. What do you remember when that was, where you were in your life, for a little context and color for the listeners who may not know you as well as our team here?
Yeah, so interestingly, one of my wholesalers, one of my company representatives who had been in the industry 40 years with one of the companies we work with, came to my office and he began to introduce this concept of infinite banking using whole life. And he was doing that in my boardroom, and I threw a fair bit of resistance and pretty harsh realities of what I thought about whole life and where it fit in the marketplace. And it was about an hour and a half of fairly intense conversation. Then we went for lunch, and he was blown away at my resistance. And that was my introduction to infinite banking. I just had been deeply programmed against it. And So when I say I had unlearning to do, I really had some unlearning to do. And he was gracious enough to tolerate me. But it was when Nelson Nash, actually, who he introduced me to, actually said this to me. He said, Wayne, you need to be quiet and listen because you're not going to learn anything while you're talking. And so I said, fair enough. I shut up and let Nelson start to talk. And all of a sudden I began to see the wisdom of this guy and I go, my goodness. Then I read his materials and I was blown away and began the quest of understanding what he was talking about. And then, as he would say, once you see it, you cannot unsee it. That's what happened for me. I actually saw what was happening, and that's a long time ago. I've shifted all my focuses basically since that time forward to helping others understand how this works and practicing it in their own lives.
Well, I find it so interesting that someone that is as wholeheartedly passionate about infinite banking and cash management with whole life insurance as you are now was initially as resistant as you were. But as someone who's newer to infinite banking myself, having just learned about it really this year, and I'm an economics major from school, and so it really started making sense really fast. I was surprised by how many people initially resist the notion that becoming your own bank can work, and by using these whole life insurance policies can actually save funds that you would be paying out in interest. So do you remember what initially those resistances that you had to whole life insurance were? Or do you remember how you ended up getting over them? Was it by reading Nelson's book? Because that's what a lot of people suggest when they first start learning about this, is to read Nelson's book. And that's definitely what I did and where things started clicking. And he does a great job getting over those initial humps. But yeah, I would just love to hear a little bit more about how you got over that initial resistance.
Yeah, so that's one of the there's an advantage in being old and there's a disadvantage in being old, and both of them have to do with experience. And so I went through the high interest rates of the 80s and 90s that Nelson refers to in his book, and I experienced that. I paid 12.75% interest on my first mortgage. So those of us renewing mortgages today at 6, 7, 8% were shocked by that. But I went through those high interest rates. I had friends lose their homes at 19 and 20% mortgage interest rates, and so during that era, of course, the universal life was introduced, and basically they attacked the whole life product aggressively, and they really hurt the industry. It was a long industry to get back for the whole life to sort of say, wow, we're an innocent victim in this attack, but we aren't going to shift our course. And they just stayed true to who they were and what they did and what they have always done for 175 years in Canada. But for me, it was, I was a zealot. I bought into the fact that I should do my own investing, and I should never think about trying to build an investment inside a whole life policy. And so one of the things that we would push extremely aggressively as Infineo team members is the whole life policy is not an investment. It's not an investment vehicle. It's an alternative place to store capital. But for me, those were really difficult things. I had a whole life policy that I bought back in the early 80s, and I cashed it in because it wasn't doing what I was told it should do by some of the other voices out there. And in hindsight, I kick myself pretty regularly for having cashed that policy in, not knowing what I know today, although it probably wasn't, well, not probably, it wasn't structured very well. But it was that journey that caused me to sort of stop and say, there's some things here that I'm not understanding, that I'm not seeing. And so eventually it all of a sudden started to click for me. And if I can just quick say this, Jackson, the very guy that introduced my company wholesaler, my internal office guy, who is brilliant, by the way, came to my office after I started practicing infinite banking and selling people on the concept. And he sat in my office and he looked at an illustration I was giving him. And he said to me these words. He said, Wayne, you need to stop this right now. You need to stop sharing this with the public. There's something wrong here. And so he took some of my documents home, and he called me a few days later and he said, "Where did you get this stuff?" And I said, "I copied it right out of your software, sir." And he went back and double checked, and he realized he didn't even understand himself the power of what he had actually introduced me to. And as I began to understand it, I began educating him on the power of what this vehicle is capable of doing. And so, as I said, I've become a bit of a zealot. I've taken some big hits in this journey, and today I'm a kid of saying everybody deserves to know. Everybody doesn't need to practice, but everybody has really the right and deserves to know what infinite banking or cash flow management of whole life is, and being able to make an informed choice of whether to apply it in their own lives and reality.
When I found that, that was incredible insight. Thank you so much. And I really was unfamiliar of kind of the rise of IUL and index universal life insurance in the 80s, kind of coupled with the high interest rates of that time period. And I can only imagine how gnarly that got for some people that tried to use cash flow management with index universal life insurance. And for those, I guess for our listeners, it might be very helpful to take a step back even and explain what index universal life insurance is and the difference between index universal and whole life insurance. And maybe our other senior agents, Liz and George, could add some color here as well.
Well, certainly Liz and George will have more wisdom than I have on this, but universal life, if we can go with universal life, because that's what we are really familiar with here in Canada. Universal life was a reaction to the high interest rates of the 80s and 90s and the poor performance, what they would classify as the absolute poor performance of a whole life policy, given the fact that you could get 8, 9, 10, 11, 12, 15% on a GIC at times during those high interest rates. So all of a sudden, the table shifted a little bit, and we reacted to that. Fortunately, the whole life industry didn't react to that, but they took a hit on the chin very, very hard. And so universal life was introduced into the marketplace at that time as a way to actually separate or categorize the life insurance or the death protection component of a policy and the investment component. So universal life has an investment component that does what investments do. They fluctuate. They go up, they go down. People that want to practice using a universal life, and I sold a lot of it to clients out of my ignorance, and so have had to kind of go back and say, you know what, that product just doesn't work for infinite banking. I mean, yes, at some level it'll work. I mean, I can use my Cadillac as a truck if I need to haul a bunch of rocks around, but it's not a very efficient vehicle to haul rocks with. You put 2 big rocks in the trunk and it drops right down to the bottom of the suspension, and it's no longer very safe to be in the vehicle. So it will work, but it's not a very efficient vehicle. And that's how I see universal life. It's not the right vehicle, and it actually won't accomplish the things we want it to accomplish. And when you understand what's happening, you'll become quite offended how universal life works in this context. And so when we look at whole life, and here's a strong statement I'll make, which maybe my colleagues can bail me out of after I make the statement, but there is no better asset for us to own corporately or personally than a properly structured, dividend-paying, participating whole life insurance policy. So let me just say that again. I won't say the whole phrase, but there is simply no better asset for us to own or hold inside our portfolio. Now, that needs to be defended and unpacked, and it probably should raise a fair bit of, provoke people to a level of discomfort.
Yeah, I actually even heard you earlier say, Wayne, that you don't like looking at whole life insurance as an investment, but yet you did call it an asset here. And some people connotate assets and investment. And so how do you get through all the jargon and really express what infinite banking and using whole life insurance policy to manage your cash can do for you? I've heard you talk about how it's really a mindset and a strategy that needs to be adopted. And I'd love to just hear a little more about that.
So I'm not sure if George or Liz want to jump in here at any point. Please do. People that know me know that I obsess about things and I just don't let them go. I'm like a good dog on a good bone. But if we understand that cash and capital are very similar in that they're both fiat currency, but one we would use to buy a cup of coffee, and when we do that, we've given that dollar away to somebody else. It'll work for the Starbucks or the Tim's or the McDonald's owner forever if they know what they're doing, but I've given it up. That's what I do with my cash. But my capital, while it's also a fiat currency and very similar, I'm going to allocate it to a specific purpose. That purpose is to help me grow my wealth. I'm going to look for things that are on sale, opportunities that I can seize upon, projects I can pursue, businesses, anything that can generate wealth or value to me. I'm going to go after that, and I need my capital to do that. And so I need to put my capital someplace that it is safe, that I have unbridled access to it, that I can leverage it, that nobody gets to tell me what to do. I get to make all the calls. I am 100% in charge. Some of my colleagues don't appreciate my terminology, but I love the terminology. I am ridiculously in charge of my capital. And I want to say that to our listeners today. You are ridiculously in charge of your capital, but there's a high probability that you've never done the hard work of wrestling through the definition and understanding capital and allocating it to a private reserve fund that incidentally you're never going to part with ever in your life. When you die, that's going to transfer to your loved ones, to your bloodline, to some other beneficiary, but we are never parting with our capital. Therefore, we must store it in a safe place where we have unbridled access and claim over it. And that's what a properly structured dividend-paying, participating whole life insurance policy affords us. As an asset, we should have that because we're going to store capital there. But if we don't understand capital, we're not going to be particularly disturbed with the erosion of our capital, when in fact that should give us sleepless nights. So as an asset, it's there to help me acquire more, not to perform all, in a market return environment. George and Liz jump in, and I'm going to make a statement and then maybe let you guys try to defend it, but I'm not throwing you under the bus. I'm throwing you out in front of wolves, potentially. But understanding that our capital must be preserved and protected forever, and we must never let it leave our ownership. And if we do, we've actually highly disadvantaged our own wealth building strategy and our bloodline. And so I just don't think people understand capital well enough to understand how important and valuable it is to building our wealth. And wealth building is really quite simple when you understand.
So I guess...
Yeah, I think that's...
Sorry, Liz.
I think that's a really interesting point, Wayne, and something that often I think gets missed in the conversation with investors. So investors work really, really hard to, and maybe you can comment on this, Wayne, in terms of what you see as well. Like I've observed that investors work really, really hard to create an asset that gives them some kind of income or passive income out of it, but often don't think about where is that passive income going and how are they using it most effectively. Often it's almost like that part of the equation, which to me is, just as instrumental because they've made all of the moves to do the hard work to acquire the asset in the first place, but haven't really understood, about how A, best to set that asset up initially, and then B, how to get that cash that's coming out of that asset work most effectively. Do you have sort of experience of that with your clients as well?
Yeah, so I think, and Liz, if I run off the rails here, just pull me back because I can tend to ramble. But there is a season in our lives where we're high production. It's all production, and we're working diligently, particularly business owners, entrepreneurs. They don't work 9 to 5 days a week. They work basically, early morning till late night, 6 or 7 days a week while they're building their wealth, while they're building their businesses or empire, if you would. But then there does come a point in time where they need to be able to say, well, how does this benefit me? I've built this great asset. How does this benefit me? And George and Liz, please protect me from myself, because when I get rambling, I often make statements that may be confusing. But boy, once I've got the capital in there and I no longer am on that journey of producing, but now I'm able to say I want to relax a bit and enjoy. Well, I've now got this incredible pool of capital that I can start to utilize for all kinds of things in my life. I can use it for personal gain. I can take vacations. I can do fun things. I can invest in my kids and grandkids. There's all kinds of things I can do. The statement I think that might need a little bit of protection is the fact that I can also utilize this asset. Brian Bloom says this, I can buy things for my future from my dead self. So all of a sudden I'm saying, well, now I've got this massive pool of capital, but maybe for one of the first times in my journey, I'm looking and saying, oh, I've got this death benefit. Well, how does that apply? And I'm going, man, when I've built up, let's just say millions of dollars of capital, and on top of that, a massive death benefit far larger than the capital, I can start to say, well, how much do my kids really need? Like, would 8 million still be okay instead of 10 million? What if I spend 2 million and just let it ride? So I'm going to say let it ride. George and Liz, I'm going to throw it to you to sort of say, what do you mean by that? Let it ride. A $2 million debt against my asset. Well, what does that mean?
I think Wayne, when you talk about using your money from your dead self, really what we're talking about there is you're taking an advance on the death benefit. So what we're talking about is living benefits, including death benefits. So this is an and asset. So it's important to understand whole life insurance as an asset, first of all, and it's an and asset that can do many things at the same time. So it's savings, meaning that it's safe, secure, and protected. Your capital is protected and your capital is guaranteed to grow. So the difference between whole life and universal life, which Wayne was alluding to earlier, universal life, you, the client, are taking the risk because you're now investing your money in the market at the risk of loss. Whole life insurance comes with guarantees. The insurance company is now taking on all the risk. So they are guaranteeing you a reasonable return on your money. They're guaranteeing you a death benefit the rest of your life. And they're guaranteeing you a cash value inside that policy that can only go up. It can never go down. It can never be zero. So they take all the risk. That's a big difference between those two types of permanent life insurance. And Nelson always said, whole life is the only tool to use if you want to become your own banker. And it's because of the guarantees. So here's something that I've heard before. I cannot claim to be the originator of this, but this helps to put the whole concept in perspective. So we're talking about an asset that is going to give us a return in the vicinity of a corporate bond. It is going to have the tax efficiency of a TFSA. So in Canada, that's a tax-free savings account. In the US, that's the Roth IRA. It has the liquidity of a money market fund, meaning that you can get that money into your account within 3 to 5 business days. And you get a 100% tax-free death benefit that is going to go to your loved ones. And then that perpetuates the whole thing, and the snowball gets bigger and bigger and bigger as we transfer our wealth from generation to generation. And the rich and the wealthy have been doing this for hundreds of years. This is not anything new. Wayne said it's been around for 175 years. It's true. The infinite banking concept that was created by Nelson Nash, he developed it in the 80s, and he wrote his first book in the year 2000. So none of this is new. The problem is people just don't know. They haven't heard of it, or they've been misinformed. So that's my 2 cents.
I really appreciate you adding that in there, George. And before we go too deep here, I just wanted to make room for our first audience question. Guys, if you do have questions for Wayne, our interviewee, or Liz or George, our senior agents who are helping conduct the interview, you can drop them at the pinned tweet, the first pinned tweet. But we actually have a question from Roni asking, sometimes I see examples of interest rates that are lower or amortized better than my whole life policy. What would be the advantage of still using my whole life policy to buy said things as opposed to external financing?
Yeah, so I think that's a great question. So thank you for the question. And the reality is that as an infinite banking participant, you are completely in charge of your finances and your financial fundamentals in future. So there are all kinds of options and alternatives for you to consider. If you can find financing at a cheaper rate, there may be advantages for jumping on that, to leveraging that, to really benefiting your own structure using other people's money. The whole point here is using other people's money. And so if you can find cheaper financing than you can find inside your policy, the next question is, do you have the education, the expertise, the knowledge, and the discipline to know exactly how to do that? It's completely doable, but you do have to understand, the pros and the cons of the consequences. And so a lot of this is based on our own behavior. As George laid out wonderfully, you know what? It is our behavior that actually determines. Yes, there's a fair rate of return, as George mentioned, against our pool of capital, but it's your behavior that actually grows that pool. And so the question that was just asked, if I can find cheaper financing elsewhere, is it logical to leverage it? And I'm going, again, I'll leave it after this, but yes, it's logical if you understand the process, if you have the expertise to administer it and the discipline to make sure that you don't fall off the rails, then that's a possibility for sure.
And a big thing that people may not focus on in terms of the outside financing is potentially the cons that you briefly started to focus on there, Wayne. It'd be great if you could speak a little more to the potential cons with not paying back your whole life insurance financing versus external financing. I think that's just a fascinating point to bring up as well. I think that you were talking about that a little bit.
Yeah, so our chief economist, Dr. Murphy, he just is so fabulous at pushing us to speak with integrity and always speak truth. And sometimes people get a little zealous about what we're doing here with infinite banking, and they can misinform or misrepresent. And so understanding that storing our capital inside this structure is sort of a non-negotiable. But how we actually cash flow, we have a lot of options, but discipline becomes the biggest question for me. Will you be honest? And Nelson talked about this as being an honest banker. Don't steal the peas if you read his book. And if you haven't read his book, I'm not going to tell you right now about Don't Steal the Peas, but it's worth your paying attention to and understanding what he's talking about. But the discipline, if you're going to do all kinds of things in the process of infinite banking, then you need to make sure you have the discipline to keep all the balls in the air and not let one drop, because one dropping can actually create havoc in other areas. And so understanding that, keeping our policy loans paid up, being a generous and an honest banker. So in talking about his here, if I'm willing to pay a total stranger and possibly even somebody I don't like, i.e. my banker or lender, if I'm willing to pay them a rate of interest for borrowing capital, then why on earth would I not be willing to pay myself more generously when I think about it? For myself, as I make this statement, I'm seeing my 5 grandchildren ranging in ages of 8 right down to 1. I'm saying my behavior today and my discipline today and making sure that I don't get myself in a difficult spot because I haven't had the discipline of keeping the funding going or the loans repaid or being honest and generous, I'm affecting their lives. And I'm pretty passionate about making sure that long after I've departed this planet, I want to know that my grandchildren and their children will continue to speak of Grandpa having laid a foundation and left them an incredible legacy in teaching them how to get out of the current, and I call it an artificially stimulated, artificially propped up economy. The only hope of our current economies in both Canada and the U.S., the only hope of them surviving is to keep our young people mired and entrenched in consumer spending and consumer debt. This is all about saying, how do we get out of this cycle and get into the place where we're managing and controlling our own lives responsibly and effectively? That's the danger when we start drifting outside of the fundamentals. And is it doable? Absolutely, it's doable. But you better understand what you're doing, or you could be potentially damaging your future or the future of your loved ones.
Thanks, Mitch, for all of that. That was really great. And I think, you really highlighted the point that there are sort of two things to consider when you're looking at what's the best way to fund something. One is obviously the maths related to the interest rate. But the second is really the risks and your likely behavior. And so for me, something that, I'm always aware of is what are the consequences or potential consequences if somebody's life changes? And, I think the recent years with, jobs that were always safe and true in pandemic times were suddenly lost through nothing related to the people themselves. It was circumstances beyond their control. So when you're taking out a loan at a certain rate, making the assumption that life will never change during the period of the loan, especially like the period of a mortgage for 25 years, is probably not, a realistic perspective. So it's probably more realistic to assume that something will change. Like even for the life of a car loan, 5 years, something could change in that time. And what is the risk? And Dr. Murphy speaks to that in terms of buying a car using a policy loan versus buying a car with using a third-party lender. What is the risk to you if you can't make payments? Now, if you buy it using a policy loan, you still get to keep the car because you own it outright, and nobody's coming after you for those dollars. Should you need to be flexible about how you return those payments? Whereas if you default on a traditional loan, then you've lost your car as well, and maybe a way to get to work to earn more money to resolve your issues. So I think, the pieces that you're speaking to, Wayne, are really important, but I think, also people just thinking through the longer term impacts of their choices. So I just want to change topics a little bit and ask you, when you're working with your clients, Wayne, what are your clients most surprised about when their use of their policies? Like what comes up for them that they didn't expect to be an advantage that they have by using their policies, that kind of, when you're doing a review with them, that sort of surprised them?
Yeah, I mean, it is a learning journey, and so there are discoveries all along the way. But I think for many of my clients, when they begin to realize that as a leader, and I'm a bit of a leadership guy, I do a lot of consulting and leadership, I say this all the time: ask better questions. You need to ask better questions. We get caught obsessing about the rate of interest. That's a big, big, big issue for people. What's the rate of interest? What kind of return am I getting? When my clients begin to understand just how little the rate of interest actually matters to the big questions, that's a pretty big aha moment for them. When they begin to understand the volumes and that they can actually recapture that volume of interest is flowing away. And it's like the difference between a garden hose and a 12-inch, emergency pump pumping out, communities or cities from a flood. You're talking a very different reality. And, the garden hose dribbles, the 12-inch or 36-inch, high horsepower pump you can't stand up against that. It's so powerful. It'll blow you over. It'll roll you down the street. That's the difference. And for my clients, when they begin to see that happening and they begin to see their wealth growing and they're willing to think long-term and begin to look at this picture long-term, I think that's probably for me one of the most exciting moments of discovery for my clients, when they quit worrying about the rate of interest or how much am I paying or how much am I earning, and realize what they're recapturing. That for me, Liz, has just been a big moment for my clients.
Yeah, that's a great answer. Thank you, George. I'll hand it over to you to ask the next question.
Sure. I was just going to say, I lost my sound for a bit, so forgive me if I'm repeating anything that Wayne already said, but a lot of it is about the direction of the flow too, right? So if you owned a grocery store, would you go down to the competitor store and buy their groceries because they're on sale? That would be my question. So it's not just about the rate, it's also about who are we benefiting and what direction is the money flowing? Is it away from us or towards us?
Yeah, and I think jumping on that, George, that's a great question. What direction is our money flowing? And most people just accept the fact that lots of money flows away from us. And I'm going, wow, it's like sand flowing through your fingers. Here's the question. Does that actually need to happen? And I'll throw that out to George and Liz as a question. Does the money actually have to flow away from us in order for us to do life and fund the things that are necessary, like vehicles and travel and all the things that go with equipment?
Well, I'd say no, it does not have to. One of the aspects that people don't consider often is the problem with paying with cash. So most people think paying with cash is a good thing, and it is better than paying someone else interest to use their money for sure. But what is happening with that cash? So once that cash is spent, you've now utilized that one purpose for that cash is to purchase something that may or may not be of increasing value. But now that cash is spent and gone and can never do anything for you again. So what is the opportunity cost associated with you spending that cash? What we're talking about is changing the flow of your cash management strategy, flowing it towards you, keeping it. Wayne has alluded to, we protect and keep our capital for the rest of our lives, and we uninterrupt that growth. So put it in our own source and our pool of wealth and capital, still able to utilize it, and it's still growing. So that's really what we're talking about. We're not talking about different objectives. We're talking about doing things differently, and you don't necessarily have to have more money to do it. It's just doing it in a better way is really what we're talking about. And then that kind of leads me to my next question for Wayne. So Wayne, what do you think about the flexibility that this strategy offers to our clients?
Yeah, again, part of the journey of learning is the fact that it's a 180-degree shift in the way we think. We have to completely think differently, and that's easier for younger people because they haven't got the unlearning to do. But the flexibility, I mean, I'm driven to show my clients the flexibility. So, and when I structure and understand this to our listeners, how these policies are structured is absolutely essential to have them structured properly. Every advisor in Canada that sells life insurance has access to doing this, but only about 10 to 15% of advisors actually understand how to maximize the efficiency of the structure. And part of that structure is the flexibility, knowing that, as has already been pointed out, I think Liz said, life has a way of throwing curveballs that we weren't anticipating. And when that happens, for instance, COVID threw a curveball at people that they weren't anticipating. For many people, that created some difficulties and hardships. For our clients, they had options and flexibility really in spades coming at them. They just had to have the awareness of what their options were, which is why you need a really good advisor. And as clients would come, we'd start helping them think through what are your options. And so, as I think about some of my clients, and right now we're working with some fairly large producers in the ag industry, their cost of operation is just beyond my comprehension. And they need flexibility for the unexpected. And inside these structures, inside these policies, we can build flexibility that staggers them. And all of a sudden they go, wow, I hear this all the time. George and Liz, I probably invite you to speak to this as well, but I hear all the time from my clients, this sounds too good to be true when they're looking at it. This just sounds too good to be true. It's like having your cake and eating it too. That's not logical. That's not common. That's not even likely possible. This sounds too good to be true. And then once they become clients and they start to practice this cash flow management with whole life, they look and go, this is unbelievable. The world needs to know about this. This is too good to be true. I mean, wow, but it is true. And I just had a conversation with my largest client yesterday, who called me and had an idea. Actually, he doesn't even really ask questions anymore. He just comes with crazy innovative thinking, and he just kind of said to me, I just can't believe, Wayne, how incredible flexible this is, and so I can do this. And I go, yeah, that's a great idea. That's a great idea. And then he wrapped up with this. Everybody in my community, everybody in my city deserves to hear this. And so I said, well, why don't you host some seminars with me, and we'll tell the people and then let them go do whatever they want with the information. But if they aren't aware, they can't actually make an informed choice. But the flexibility that we can build into these structures is quite staggering.
Yeah, it's certainly something that I hear often from people. Like, when they catch it, is how I'm going to phrase it. When they catch how this really works, most people say, why didn't I not know about this when I was at school? Why isn't this being taught to me? So if you were to be able to determine financial education in our school systems in North America, Wayne, what is it that you would have every child learn about cash versus capital? What is something that you think would be really beneficial for every child to know?
So, Liz, I can't help myself. So somebody might want to cut me off, just technologically shut me down when I make this statement. But I have very little confidence in our education system to actually be able to teach the things that our kids really need to know about this. And that's a strong statement. But we're not learning this, not in our public schools, not in our colleges, and not in our universities. We're not learning this stuff. Professionals aren't learning this stuff. And so when I think about my grandchildren, I've already put structures in place for each one of my grandkids that my wife and I fund every month. And we will do that until such time as we can gift this structure to them. And that isn't going to happen until I'm absolutely confident that they know how to utilize it and responsibly manage it. And incidentally, when we put these structures together when they were each born, we went to their parents and said, we will put a structure in place if you will. And so the parents are going, well, that's a pretty good deal for us. And so all of my kids put policies on their own kids, and my wife and I did as well. Now the capital is building there. Now we've got to teach them how to build and leverage capital. And so every child should understand, you don't part with capital, not ever. If you're going to buy candy with your money, that's going to cost you. They will have no ability to comprehend what it's going to cost them in lost opportunity costs. And so for my grandchildren, I am currently saying you must understand capital. You must understand the preservation, protection, and leveraging of capital. And so as a bit of an aside, my oldest grandchild is 8 years old now, and 2 years ago I bought a power washer for him. And then COVID was part of a bit of an issue at that point still, but so we haven't really got this leverage fully. But I bought a power washer for him because we live at the lake in the summer, and lakes tend to attract spiders, and spiders tend to make a mess on cabins, and people are out every morning trying to clean the spider webs off. And I'm going to my little buddy, I'm going to buy you this power washer through your policy. You're going to have to refinance this, and you have to replenish the pool. But now I'm teaching them how to produce capital. And so we're going to go out and spray off cabins for people and clean those spider webs off and charge them a fee. Let's just say it's $50 to do that. Now he needs to know what to do with the $50. Well, he has to put at least a portion of that away into a private reserve so he has it for his future. And then that just opens up new doors of opportunities. We're going to make a mess of their windows. Well, why don't we offer to clean their windows for $50? And then why don't we mow their lawns? And why don't we expand this thing? And why don't we start to figure out, Matt, if I got capital, by the time I turn 18, 19, I can buy whatever vehicle I want. But by then, hopefully, they'll understand there's a particular value you need to place on vehicles. But now they're understanding capital, and they're producing capital, and they're protecting it and preserving it and leveraging it. And I'm going, every child in Canada and the U.S. deserves, in fact, every child on the planet deserves to understand how that works and why capital is so important. And yet, my guess is because most of my adult clients don't have a definition of capital. Our friend James, and he's a good friend and colleague, he hates my use of the word acquisition, but capital properly defined is property value in monetary terms for acquisitive purpose. That's the proper definition of capital. I doubt 90% of educators can define capital well. Now, that's a statement that who knows if it's accurate, but a high percentage of society can't actually speak wisely to capital.
I think it's interesting too that we, Liz brought that up. Why aren't we learning this stuff? And we get these questions all the time. If this is so great, why isn't everyone doing it? This is so great. Why haven't I heard about this before? This is too good to be true. We get those statements all the time, and it's because you don't know what you don't know, basically, right? If you haven't heard about this, if you haven't been educated, if you haven't caught it, right? Nelson always said this can't be taught, it has to be caught. It has to be discovered. You have to figure it out in your own mind, and you have to think differently. So if you haven't been taught or told or educated, then how would you know? You just wouldn't know. And institutions don't want us to know this because they're not going to benefit. The government doesn't want us to know about this because they're not going to benefit. The insurance companies, we are the marketers for the insurance companies. We do the marketing for them, and they pay us to do that. So if we aren't out there telling people and educating people, they're just not going to know. So you just don't know what you don't know. That's as simple as an answer we can come up with, really.
Don Blanton makes this statement, and I love it and use it often, but if what you believed to be true turned out not to be true, when would you like to know? I think that's a profound statement. He also says there are wealth transfers that are occurring in our lives that are happening either unnecessarily or unknowingly. And if we could actually show those to you, would you actually let us do something with those wealth transfers to build your own wealth? Those are great questions, and those are things that a lot of people, when they start to take responsibility for their own financial future, begin to discover, and they do say, why have I never been told this or taught this? Why is this not common knowledge in our society? And I'm going, George, you're too kind when you say the government doesn't want us to know about this. Quite honestly, the government doesn't have a clue about this. They're just human beings working in government. But it was John Maynard Keynes that made this statement: only 1 in a million people could ever understand inflation, which in Canada, it's a little different in the U.S., but in Canada, that's less than 39 people. And there's more than 39 people in government. They don't understand much of what we're talking about. In the U.S., we probably got 330 to 350 people if Maynard Keynes is correct. And that's what our whole economic system is built on, is Keynesian economics. We're Austrian economists, and we're starting to understand that what the society is thinking and seeing is it's just not an accurate reflection of what's taking place.
And I think people often, when you talk about wealth transfer, people often say, well, I don't pay credit card debt, right? Like I don't pay interest on my credit cards, so I'm not losing money. Can you speak to that a little bit about what you mean by, like the wealth transfers that are going on? It's quite beyond the, not paying interest on your credit cards.
Yeah, I think people don't really understand. They say, I don't want an interest payment. But you may not have an interest payment, but you are going to have an interest cost. So if you don't understand what's happening, you aren't likely to behave responsibly or appropriately. But these wealth transfers that are taking place that don't need to take place, if we could actually identify that, I say this to all people all the time. If you're making $100,000 a year, and let's just say you're saving 10%, my question is, and I say this often to clients, would you let me manage the money you're not keeping? I can do so much more for you by managing the money you're not keeping than I can by managing your portfolio of investment. So that's a bizarre question. Can I manage the money you're not keeping? But I'm going after the fact that there are wealth transfers that are bleeding out of your system. It's like a bucket with holes in it. And I'm saying if we could recapture 1% of wealth transfer, so out of 90,000, if we could recapture $900, you would need like 19% return on your investment portfolio to make up for that. And I'm saying I probably can't get you 19%, year over year over year for 40 or 50 years, but I can find you 1% of wealth transfers that are occurring inside your operations where $90,000 is flowing away from you. Let's just recapture it. Maybe it's more than 1%. Maybe we can get 10%. Or whatever the number is. But people just aren't aware of what's actually flowing away and what the implications of that are. And it's absolutely staggering. And then Nelson would have pushed this as well pretty aggressively to say, we need to think long term. So every time I work with a client, I think from today until life expectancy being 85. So I had a client last week sitting at their kitchen table. They had an extra $50,000. They're amazing people, but they had an extra $50,000. They're going to do something with it. One member of the marriage said, let's put it inside our policy and then leverage it. The other one said, I don't know, let's leave it in our bank account because we got bills to pay. And as I sat down and I said, well, you got 42, I can't remember if it was 42 or 52 years of life expectancy left. What could that dollar do if you put it into your capital pool and preserve it forever? And it was like $632,000. And I'm going, that's what's at stake here, not understanding that. You're going to try to do something different with that 50 grand, and you're going to give up $582,000 of potential growth. That's rock solid, safe, and certain by not understanding. So that opportunity that flows away from you it's difficult to see, or as Liz said, catch. But once we start to understand what's happening, we start to think differently. And we still have to have expenditures. We still have to buy things. We still have to live. But can we live more efficiently? First of all, effective. As a leadership guy, I'm going, anything worth doing is worth doing poorly until we can learn to do it well. But eventually we should learn to do it well. That's the efficiency of our capital. And again, I go back, what should we be teaching children? If children learn the value and importance of capital, our society would change rapidly.
Thanks, Wayne. I know we're just about out of time. Do we have any listener questions, Jackson, before we've got time for one more question?
We don't have any specific listener questions here right now, but I'm going to stall for a second and give our listeners some time to potentially drop a last one in here. But I'm not seeing any come in here. And so I honestly would just love to hear, Wayne, as we wrap this up, what is the best first step that anyone listening that is not practicing infinite banking in any capacity, doesn't have a whole life insurance policy, may not even understand what it is? What is the first step that anyone on this call should take towards securing their capital and for generations to come?
So let me answer that first, Jackson, through a leadership lens. Good leaders do a few things. First of all, they take responsibility. So that'd be a first step. Take responsibility for your own education. Secondly, they do productive things. So what is it that you need to do to be productive? You need to probably find a coach. You probably need to start looking at and reading and understanding and learning. And then you need to make some difficult choices. So this is not for the casually interested. You're going to have to do take responsibility, do some productive things, make some difficult choices. But when you do those things, you'll be in a position to serve others, which really is the heartbeat of a good community, is when we actually do life together and serve. And so I would say a good first step would be to say, man, I need to commit to educating myself. Secondly, I need to do something productive. So I'm going to find a coach. I would encourage you to get on our Infineo website and find one of our coaches near you, or call one of us, and we'll either help you or direct you. Then it's to start making some difficult choices. I'm going to spend some time reading. I'm going to spend some time learning about this. I'm going to learn to ask good questions, and then I'm going to sit down and look at my own situation and run a comparison based on what I'm doing versus what these guys are suggesting. And, I think when you do those things, you'll be in a very good position to say, this is something I need to pursue or not.
And so I've got good news for all of our listeners. They've technically taken a first step. They're here, they're listening, they're educating themselves. And I've made it very easy for everyone to take the second step and find a coach. As you guys have heard throughout this conversation, we have 3 industry experts who all practice this in their own lives on stage, and they'd all be happy to help you figure out how and if in what capacity this will work in your own life. And so if you are ready to find that coach that will hold your hand and help you through this process, you can look at the pinned tweet, the most recent one, and you can click the link to schedule. Either if you're in Canada, click the Canada link. If you're in the US, click the US link, and you'll be able to schedule a call with our senior agents here on this call. And yeah, we'd look forward to getting you some more personalized information and coaching on your specific financial situation. And with that, we are coming up on time here. Is there anything before we wrap up here that you want to leave the listeners with, Wayne?
I just think that it would be important for you not to just follow the traditional systems, because clearly they're not working. They're not working for you. They're not working for the other members of society. So at some point, we have to take responsibility, think different. And that would be my biggest challenge. Just take some time to think about what you're doing in light of what we've been sharing, and how capital might begin to serve you if you actually defined it and then began to build a private reserve fund that you could leverage. And the learning journey will be, first of all, a little bit difficult and extreme, and then all of a sudden you'll just start to soar and you'll be going, wow, why didn't I learn this earlier? That's certainly my story. I wish I knew this when I was 20. But maybe you are 20 or 20-year-olds. The sooner we get started, it's why I focus on kids. I can change the world by helping kids understand this. And I loved Liz's question about what the children need to know.
Thanks so much, Wayne, for all your valuable insights. And I really appreciate you sharing all your wisdom with us and the audience today. Thanks, everybody.
Thanks all.
Before we sign off here, guys, if you could just tell the listeners where they could reach you if they're interested in getting in touch, that'd be great.
Yeah, Liz, maybe I'll let you go because you will know all of the avenues.
Yeah, so you can go to our website, which is infineogroup.com. So I'm going to spell that. That's INFINEO and then the word group, GROUP.com, all written as one word. And you can also reach out to myself, George, or Wayne with our first name dot last name at infineogroup.com. So if you'd like to speak with one of us, that's the best way to get in touch. And you can also connect with us through the website.
And don't forget, you can book a call right at the link in the pinned tweet. Thank you guys all for listening, and we look forward to seeing you next Tuesday. Have a good one.